Hello, it's Stanzione with a financial update and some trading ideas. I'll talk to you a little bit about the Making Money from Financial Spread Trading course. I'm filming this the first few days of July 2017. Before we get started, the usual disclaimers: any shares or ETFs or spread bets that I mention in this update are for information purposes only. Great, let's get started. So if you cast your memory back to November when Trump was first elected, and you can search this in Google, why the Dow will rally 30% under President Trump. This is one of the articles that I wrote. At that time, most people were quite bearish on Trump coming in. Dow was around 18,000, and I basically said, look, Trump overall should be good for markets. And I said, we should expect the Dow to hit 23 to 25,000 in the first 4 years. So remember, we are still in the first year of Trump. But we've done pretty well as I'm recording this, around 21,000 on the Dow. And I started buying in October 2016. In fact, I've been bullish on US stocks, and you can check this since 2011 when the Dow was 10,700. So that's up around 100%. Of course, with leverage on things like spread bets, it's up more than 1,000%. And this is what I said, forget about the noise. After all, Trump is a businessman. And okay, he hasn't probably got as much through government as some people were hoping, but you can see overall Trump has been good for the US stock markets. And that's what I said back in November 2016. Now, I don't want to sort of boast or blow my own trumpet, but I think I will blow my own trumpet because really my track record is excellent. And if you can find somebody with better track record than me, then go and follow them and then let me know and I'll put my money with them, because everything that I do, you can easily just search me and find out. And when I called the Dow at 14,200, everybody laughed. That was back in 2011 when I said oil would go down at $50 when it was 110. There was over 2,800 mainly negative comments saying that was never going to happen. Of course it did, and in fact we went below $50 a barrel. Last year, or rather in 2015, I said that the Dow would hit 18,500 in April. Now it was a month or so late, but of course we reached that, and in fact we've gone a lot higher than 18,500. Now, I mainly trade US stocks and US markets, so you might be watching this in the UK or Europe, and it doesn't matter where you live, it doesn't matter where you're based. I suggest you make the US market your main market to trade, purely because just the size, it's the biggest market out there. So I'm going to concentrate mainly on talking about US stocks, but you can trade these just as easily as you can trade UK or European stocks. Now, 20 years on the Dow, stocks have done a lot better than most people think. Of course, it's not been up in a straight line. However, stocks have done very, very well. And again, this is my little write-up. And again, you can search this. It's on Google. What I said in September 2011, that I was looking for the Dow to hit 14,200. The S&P 500, which is the broader index, obviously it's 500 stocks, that's also setting up a new high. And then the NASDAQ 100, which is more based in technology. For instance, Apple is the biggest holding, and biotech stocks. Now, I'm a little bit concerned about the NASDAQ 100, especially shorter term. It has had a very, very strong run and is likely to see some profit taken over the next few months. But of course, we can make money from that as well. Now, although stocks are at all-time high, as I've just shown you, the majority of IG index customers, people that are spread betting, are in fact short. And they have been pretty much this whole rally. So what that's telling me is a contraindicator, because on the whole, the majority of spread betting company clients don't make money. So it's the few that actually make the money. So overall, you actually want to be with the minority, not the majority. The other thing, from where I sit, I'm not being inundated with calls or emails saying, talking about stock market. Even though, as I say, as I'm just recording this, the Dow's sitting at an all-time high, I don't hear any cheers. So there's hardly any euphoria. And in fact, most people are quite skeptical about the stock market, and most people are still, not investing in the stock market. Now, the number of companies floating in the US, it's hardly a flood of issues. So if you remember back at school in economics, supply and demand, so the amount of IPOs, initial public offers, in companies coming out, there are not many companies coming on the market. In fact, there are actually less shares listed in the US now than there were. The Wiltshire 5000 is actually more like 3,700. And the reason why there are less stocks on the market is because many are merging or being taken over. Now, if you know basic economics, supply and demand, if we've got less stocks in the market, also companies buying back their own shares, then of course prices go higher. Now, valuations are not a bargain. I'll be the first one to tell you that. If you look at the PE ratio, I was telling people to buy stocks back in 2011 when most people didn't listen, and that of course was a great time to buy stocks. Valuations were much lower. So right now we're sitting on a forward PE of around 17.5, probably a little bit higher than that now. Actually, it's about 18. So stocks are not a bargain, but we are still in a normal-ish or slightly higher to normal PE ratio. Of course, back in the dot-com boom, which was March 2000, the PE was 27, and we're nowhere near that. Now, the reason why it's not as high as maybe a lot of people would think it is because the E, so the earnings in the price earnings, have actually been going up. So as the earnings goes up, it helps to sort of factor in the price. Of course, for stocks to carry on going higher, we do need to see earnings remain strong. Otherwise, these prices can't be sustained. Now, seasonality, I'm a fan of seasonality. You might have seen some of these charts before. Let me just go through it for some of the newer people that are watching this. Now, the reason why we've got this broken down in odd and even years, and again, everything I do is US markets. So even years are election years. So 2016, obviously an even year was the election year, and midterm elections, which will be next year. Odd years, as we are this year in 2017, there are no elections. Now, overall, markets prefer it when there are no elections because it takes out some uncertainty. Now, if we look at where the gains in the stock markets tends to happen, it tends to happen at the start and the end of the year. And some of you might have heard the old saying, sell in May and go away. And in fact, my seasonal system is actually out the market at the moment. Now, this line is roughly where we are now. So it doesn't mean we go out and sell everything because there are still plenty of opportunities. But if you look, the big run-up tends to happen towards the end of the year. And we're now in this sort of sidewaysy sort of action, but there's still plenty of money to be made in individual shares. Now, we can make money in all markets. We can use things like fixed odds bets or binary bets. Majority of my money I make from A and B, which is trends, things that are trending up or things that are trending down. Now, expect the next few months to be choppy. July, August tend to be a little bit quieter in markets, holiday months going into September, and then we tend to get more active. But this is not a bad time if you're thinking about starting out learning to trade. This is a good time to get ready, to practice, and there are still opportunities to make money. Now, there's still plenty of opportunities to say, even if we get some big swings. I think technology, you've got to be careful, has got to some valuations which are looking a little bit frothy. Any sort of disappointment in earnings, you're going to see some of these stocks come down quite sharply. Now, this is the S&P 500, and you can spread bet all these stocks or just buy them for a normal broker. And the S&P 500 is up about 8% so far this year, which is pretty good. It's not bad for an index to be up 8%. But of course, individual shares are up a lot more. Win, which is one of the stocks that I've been trading as a casino stock in China and Las Vegas, is up 50%. Yum China, which is KFC and Pizza Hut, that was spun off out of Yum Brands, 55. ATVI's Activision, that's one of the stocks. Race, which is Ferrari, that was part of Fiat. In fact, Fiat still owns a big part of that, has been up as well. And as you can see, these are some of the individual stocks which are up, and of course some stocks are down as well. But what I'm trying to drum in is there's a lot more money to be made in individual stocks rather than trading the whole index. And a lot of new traders, they want to trade the FTSE, they want to trade the Dow, and yet they're fine. But if you look, say the S&P is up 8% against a stock that's up 50%, you can make a lot more money in individual shares. Now, the rest of 2017, I think the focus will be targeting long and short trades rather than just individual stocks. Now, something else you can look at are sectors, and you can spread bet sectors as well. So a sector is a bit like a halfway house between the big index and an individual share. And as you can see, so far this year, energy sector's down 15%. Healthcare has done really well. That's a sector which I still like, and technology has done well. We can also look at what's called pairs trading. So what pairs trading is maybe where you could be long the S&P 500, short energy, or short energy sector, long healthcare. So you're trading one pair against the other. Now you can spread bet sectors very easily. The reason I know, because I helped to set them up, and this is with IG Index. So you can trade the healthcare index sector, and you can trade that long or short just as easily. You can trade from relatively small pounds a point. Now, small cap US stocks, which are not so small, I think is where you've got a lot of big opportunities. And again, you can spread bet many of these, or you can just buy some of these stocks just through a normal broker, and I can help you set that up. Now, I believe biotech will be very, very active as we go into September. There's going to be a lot more deals. And what it is basically, it's like the big dogs buy the small dogs. Because some of these small biotech companies, they may have a good drug, and a lot of the big guys, rather than go through all that process, they've got a lot of cash on their balance sheet, so they just buy out the smaller companies. So that's something that you want to have a look at for the rest of the year. Now, these are obviously higher risk companies. I'm not saying go out and buy them. A lot of these are biotech, but just show you some of the gains that have been achieved, and this is year to date. So if you look at this last column here, you'll see there's a lot of 300-400% up stocks, and some of these were like $3-4 type stocks. So it's higher risk, higher reward, but that's just to give you some ideas of what's been achievable. Now, a little recap on US listed companies. A nano cap is normally 50 million or under. Micro cap is 50 million to 100 to 200 million, and then small caps, which are actually not so small, is 200 million to 2 billion. And a lot of these smaller caps, they moved more on news rather than the general market. Now, these stocks are normally trading from $1 to about $20 a share as a guide, so they're a little bit more easier to buy, especially on smaller accounts. Now, the company must be listed on the NASDAQ, Amex, or NYSE. I don't trade over-the-counter, OTC, or pink sheets. If you ever saw a film called The Wolf of Wall Street, if you remember that there was some questionable deals going on there, and there was a stock called Aerodyne, and I think they were at 10 cents a share or 6 cents a share with a huge spread. They're the sort of stocks you tend to get on OTC or pink sheets, and I stay away from there. And on the whole, I stay away from UK listed penny shares as well. So it's mainly US listed stocks that have got some liquidity that I trade. Staying with the sort of healthcare biotech theme, this is an ETF of biotech, so it gives you a basket of biotech stocks. In fact, it's 95 stocks in one trade. Stock we've done actually very well with this year is Clovis, CLVS, which is actually in there. But if you want to get involved with biotech without taking risk on just one stock, this is a good way to do it. The stock I mentioned a little bit earlier, which is Yum China. So this is basically the Chinese side of KFC, Pizza Hut, and they've got a couple of other brands in there as well. They also own Taco Bell as well, which could be rolled out. So the reason why you haven't got much chart history here, it only spun out of the parent company, which was Yum Brands, late last year, but that stock still looks good. Casino stocks have done pretty well this year. Again, there's a China element to that as well. But also having Trump as your president, you know, if somebody said to me a couple of years ago, oh yeah, the president will be somebody who's had experience or been in the gaming or casino industry, I thought I'd never believe it. Now, if you remember, President Obama, he never really liked the casino industry, whereas obviously Trump has been much more friendly to the hotel and casino industry. So that's one area to look at. Now, here's a stock that has been a terrible investment. In fact, the only way you would have made money here is by being short. It's a company called Valiant. VRX, it's listed in the States, and if you look at this, it went from $250 basically down, I think, to $8-9 at the lowest. Now, if we look more recently, things are starting to turn around, and no one's saying that Valiant's going to go back to $100 or even like $60, but I can see probably a 50% upside here. Because there are some things that are turning around there. But that's a stock that you might want to have a look at as an idea. Obviously, it's a high-risk idea, and we're talking about where we are now, not where we've been. And you'll see, basically, it is starting to make a bit of a turnaround. And that's a pharmaceutical stock that was very, very out of favour, did a lot of bad things, made a lot of mistakes. However, we're starting to see a turnaround there, so it's one you might want to have a look at. Now, you do need to start making some smart investments. The good news is a lot of us are living much longer, 80, 90, 100 is going to be far more achievable. So that's great. People are living longer. The problem is most people are not going to be able to fund their retirement or their lifestyle after 65 or whatever, it's going to be pretty poor. So the only way you can do that and maintain your purchasing power is by investing and trading wisely. So looking after your money. Just having cash under the mattress doesn't work, and I'll explain to you why. Now, we've based this assumption on a inflation rate of about 4.29%. Now, some of you say, oh, that's maybe a bit high for inflation, but I don't believe what the government figures tell you, and if you do, then that's your choice. But if you look around you, most prices are going up. Packets are getting smaller. So it was 500 grams, you now get 375 grams. Of course, that's a way of bringing the price up without it sort of being noticeable. And if you've got 50,000 pounds today, it's got to be around 175,000 in 30 years' time to have the same purchasing power. So let's say you've got £500,000 now, thinking, oh yeah, that's a great amount of money, that's going to last me into retirement. The problem is, as I say, the cash is going to become worth less and less, and interest rates remain relatively low, and as I say, there is certainly inflation in the economy, so your purchasing power is going down. So that's why learning to trade, investing in stocks, is a very, very good way to sort of diffuse the inflation issues. Now, this chart here shows the difference between reinvesting dividends or just taking the dividends out, and you can see there's a huge difference. Also, what you see here is that small caps have actually done the best out of large caps. Okay, yeah, there's some higher risk, but if you diversify, those can be mitigated. But overall, smaller caps have made more money than the large caps, and certainly beating inflation or bonds. Now, some of you know me for financial spread betting, and I've got the best-selling course on that. However, I can also help you with more sensible trades. You can use my systems for ISAs. You don't have to do everything in high risk. So if it doesn't have to be everything's 100% gains, we can help you with sort of smaller, lower returned, but obviously lower risks as well. So it's not a case of everything has to be high risk. Now, if you want to go further, say the Making Money from Spread Trading course, it's exceptional value. In fact, I haven't put the price up of this for some years, and I am due to do that shortly. But you can basically use this for share dealing, FX, CFDs, if you're in Europe, spread betting. It's an easy to follow workbook, you get DVDs, it's members site, you get full support, and say you'll be dealing with me personally. I actually answer my emails, unlike most people. Take your money, never hear from them again. There's a clear buy and sell system. It's not based on day trading. You can do everything in less than 20 minutes a day, anytime suit you. If you trade in US markets, they close at 9 o'clock UK time, 10 o'clock Europe. So you can do those in the evening quite easily, or first thing in the morning. And I say, if you go to www.winonmarkets.net, you can read more and watch a couple of video clips there as well. And I say, everything comes with a 100% money back guarantee. Now, you might have heard this little story before, but about the electrician who goes in and he turns a screw and the power comes back on again, sends him a bill for $1,000, and he says, well, how can that be worth $1,000? Well, turning the screw, that's $1, but knowing which screw to turn is $999. And that's the thing with my course, and why it's investing in yourself and investing in the course makes sense. You're paying for my experience. It's not that you're paying for a bit of paper and a couple of DVDs. It's the information. And I don't know about you, but I would rather pay somebody to help them rather than have to go and work this all out yourself. And people think, oh yeah, you can get it all free on the internet. No, you can't. You can get some little bits by all means free on the internet, but quality information doesn't come for nothing. And I know probably the time you're watching this, you're at holiday times. A lot of people think, I'm just spending money on my holidays, and that's great, have a lovely time. But the way that I became a multimillionaire and the way that I've built up my wealth is basically by reinvesting and investing in myself, and investing part of my profits and not spending them all. So it's much better basically to invest in things that don't rust, rot, or depreciate, and then obviously you can use that money to buy other things that you want to spend on. Anyway, that's my little update. As I say, first 6 months of the year have been excellent for us. I think the next month or so is going to be a little bit quieter, but it's not a bad time actually to start getting in. And then we're going to have to put the foot down for the last few months of the year and make some great profits. Now, if you want to be involved in that, if you want to follow me and find out what I'm doing and learn the same sort of systems, then now's a great time to get started. If you've got any questions, send me an email, vince@finbets.com. I promise I'll come back to you. And I'd say if you want to learn more about the course or the course, just go to www.winonmarkets.net. Thanks for watching.